Friends, thank you for being here today. What if I told you that the red numbers flashing on your screen right now, the ones causing a knot of panic in your stomach, are essentially a lie designed to separate you from your wealth? And what if I told you that while you are being pressured to sell your silver at $75 in New York, the savviest industrial buyers on the other side of the planet are scrambling to buy that same metal for $89, begging for every ounce they can get? We find ourselves in a moment of extreme cognitive dissonance. It is the morning of December 29th, 2025. Many of you are likely looking at your portfolios, at the financial news tickers, and feeling a profound sense of unease. I know exactly what you're feeling right now. I know the anxiety that creeps into the back of your mind when you see a sudden violent drop in the value of an asset you believe in. You are looking at silver trading at $75. Just 48 hours ago, we were popping champagne corks. We were watching the price flirt with $80, celebrating an all-time high of $79.57. The conversation was filled with optimism. We were talking about triple digits, about the unstoppable squeeze, about the vindication of years of patience. And now, on a quiet Monday morning, seemingly out of nowhere, the floor has dropped out. We are down $4, maybe $5, depending on the minute. The chart looks broken. The momentum seems dead. If you turn on the mainstream financial media, if they are even bothering to cover precious metals amidst the holiday fluff, they are likely telling you that the bubble has popped. They are telling you that the squeeze is over. They are using scary words like correction and capitulation, advising you to sell now before it goes back to $50 to preserve what's left. I am here to tell you to stop, take a deep breath, and listen very carefully. What you are witnessing right now is not a crash. It is not a correction. It is not a change in the fundamentals of supply and demand. Supply did not suddenly appear over the weekend. The mines in Mexico and Peru did not suddenly discover 1 billion ounces of silver on Sunday night. The impending Chinese export ban did not get canceled. Nothing has changed in the real world. What you're witnessing is a trap. It is a specifically engineered, mathematically calculated high-frequency trap designed for one singular purpose: to steal your position 3 days before the world changes forever. Before we break down the mechanics of this trap, if you value this kind of urgent market intelligence that the mainstream media ignores, please take a moment to like this video and subscribe to the channel. It helps us reach more investors who need to hear this message before it is too late. To truly understand the nature of this panic, we first have to look at the situation on the ground. To understand why this is happening, we first have to detach ourselves from the emotion of the red candle. We have to look at the market not as a casino, but as a mechanism. Imagine you are holding a winning lottery ticket. You know the numbers match. You know the payout is guaranteed. But 3 days before you can cash it in, someone comes up to you and offers to buy it for half its value, screaming that the lottery commission is bankrupt. That is effectively what the paper market is doing to you today. The drop to $75 is terrifying on a technical chart. It creates a massive red bar that screams sell to every automated trading bot in the world. But we must ask the question, why? Why would anyone with a massive short position, anyone who knows about the global shortage, who knows about the industrial demand, choose to smash the price today? Why force it down to $75 right now? The answer lies in the calendar. We are currently in a period known on Wall Street as Ghost Week. So what exactly is the mechanism behind Ghost Week, and why does it matter? Ghost Week refers to the specific trading days between Christmas and New Year's Day. It is a unique phenomenon in the financial world, and understanding it is the key to surviving this drop. During this week, the adults are gone. The senior risk managers at the big banks, the heads of the trading desks, the institutional whales, and the decision makers, they are all in Aspen. They are in the Hamptons. They are on their yachts in the Caribbean. They are not sitting at their Bloomberg terminals in Manhattan. So who is running the market right now? Who is setting the price of your retirement assets on this Monday morning? It is the junior traders. It is the B team. And more importantly, it is the algorithms. When the senior leadership is away, liquidity in the market becomes incredibly thin. Liquidity is simply the ability to buy or sell an asset without drastically moving its price. In a normal market, say a Tuesday in mid-February, if a bank wants to sell 1,000 contracts of silver, there are 10,000 buyers waiting to absorb that sale. The price barely moves. It is like throwing a rock into the ocean. The ripples are tiny, but during Ghost Week, there are no buyers. The order book is empty. The bids are hollow. So when a bank decides to dump 1,000 contracts into this vacuum, the price doesn't just dip, it crashes. It is like throwing that same rock into a bathtub. The splash is enormous. This drop to $75 is a liquidity illusion. It is an air pocket. The sellers pushed the button, and because there was nobody standing there to catch the falling knife, the price free fell until it hit a technical support level. It looks real, but it is manufactured by the environment. The market today is incredibly fragile. not because the asset is worthless, but because the room is empty, and the sharks who are left in the room know exactly how to exploit this emptiness. This brings us to the psychology of the crash and the institutional hunt for stop losses. Why would they do this? Why create a crash? The answer is psychology. They are playing poker with your emotions, and they can see your cards. The banks and institutional algorithms know that retail investors, people like you and me, are often leveraged. They know that many people chase the price when it hits $78 or $79, perhaps buying call options that expire this week or buying on margin. Most importantly, they know exactly where your stop-loss orders are hiding. For those who might be new to the term, a stop-loss is an order you give your broker that says that if the price drops to 76, sell my position automatically to protect me from losing more. It is a safety net. But in a thin market, that safety net becomes a target. The banks have a map of where the pain threshold is for the average investor. They can see a cluster of thousands of sell orders sitting at $76. So in this low volume environment where it costs them almost nothing to move the price, they simply push it down. They sell just enough paper silver to drive the price to $76. Once they hit that number, your computer takes over. It automatically sells your position. You panic sell, you dump your silver back into the market, and here's the most critical question you must answer. Who is on the other side of that trade? Who is buying the silver that you just panic sold at $75? It is the same entities that smashed the price. They are the ones buying your silver at a discount. They are shaking the tree to see what falls out. They are clearing the deck. They want to flush out the weak hands, the tourists, the gamblers, the people who don't understand the long-term fundamentals, so that when the real move starts in January, the train is lighter. They don't want you riding with them to $100. They want your seat. This is a classic bear trap. It happens at the bottom of every correction, and it happens right before every major breakout. It is designed to make you feel stupid. It is designed to make you doubt your thesis. You look at the screen and think, maybe I was wrong. Maybe there is no shortage. Maybe I should just take my loss and go home. If you have that thought, they win. But there is a smoking gun, a tale of two markets that exposes the truth. If you need proof, undeniable mathematical proof, that this $75 price is a lie, we only need to look to the east. While New York is trading at $75, there is another market on the other side of the world that is telling a completely different story. We need to look at what is happening in Shanghai. While American investors are being tricked into selling, Chinese investors are doing the exact opposite. They are paying a price that would make your jaw drop. They are ignoring the COMEX spot price completely and setting their own reality. Let's look at the numbers coming out of the Shanghai Futures Exchange, SHFE, right now. Because when you see the number, and when we do the conversion together, you will realize that $75 is the biggest lie of 2025. As of this morning, the closing price for the front-month silver contract in China is 20,073 yuan per kilogram. Now, unless you are a currency trader, that number probably means nothing to you. So let's do the conversion into the language Wall Street understands, which is US dollars per troy ounce. We begin by taking the price of 20,073 yuan and dividing it by the current exchange rate of roughly 7.025 yuan to the dollar. That gives us approximately $2,851 per kilogram. From there, we simply divide that figure by 32.15, which is the number of troy ounces in a kilogram. And the result is $89. I need you to let that sink in. $89. That is the price of silver in China right now. But if you look at your broker app, if you look at the paper market in New York, it says $75. That is a spread of $14. That is roughly an 18% premium. I want to pause here and ask you a question. Do you believe this $14 spread is a temporary glitch, or is it proof that the Western market is broken? Let me know your thoughts in the comments section below. I read every single one, and I want to know if you are buying this dip or sitting on the sidelines. In the world of global finance, an 18% spread on a fungible commodity like silver is theoretically impossible. It is like seeing gold trade at $2,000 in London and $2,400 in New York. It shouldn't exist. In a normal functioning market, arbitrage traders, the sharks of the ecosystem, would feast on this. They would buy every ounce of silver in New York for $75, put it on a plane, ship it to Shanghai, and sell it for $89. They would make a risk-free $14 profit on every single ounce. They would do this over and over again until the buying in New York pushed the price up and the selling in China pushed the price down, closing the gap. So why isn't it happening? Why is the spread sitting there wide open like a gaping wound? Because arbitrage is dead. The bridge between the two markets has been severed. And what severed it? The January 1st export licenses. This severed link is caused by the ultimate catalyst, the January 1st export ban. We are exactly 3 days away from the single biggest structural change in the silver market in our lifetimes. On January 1st, 2026, the China export licensing system goes live. This is the deadline. This is the moment the supply chain officially snaps. The banks know that they can't ship metal into China and expect to get their money out easily. But more importantly, the Chinese sellers know they can't ship metal out. The flow has stopped. The global market has bifurcated, leaving us with two distinct silver markets on planet Earth. On one side, we have Market A, the paper market in the West. This market is dominated by derivatives, algorithms, and ghost week volatility. It is currently priced at $75 simply because there is no immediate physical delivery pressure today. On the other side, we have Market B, the physical market in the East. This market is dominated by industrial users, solar panel factories, and strategic government orders. It is priced at $89 because they actually need the metal. Which price do you think is the real one? Do you trust the paper contract that settles in cash? Or do you trust the physical bar that goes into a factory to build a solar panel? China is telling us the real price. The real price is $89. New York is lying to you. The reason the price is skyrocketing in China, despite the local supply, is because the local industry is terrified. They are front-running the ban. Think about the psychology of a Chinese industrial buyer right now. They know that in 72 hours, the export rules tighten. They know that domestic supply is about to be locked inside the country. You might think that if supply is locked inside China, the price should go down because there is a glut. That assumption is wrong. The price is going up because they are turning the Chinese market into a Hotel California. You can check the metal in, but you can never check it out. The industrial giants, Tesla's gigafactories in Shanghai, the massive solar farms in the Gobi Desert, are bidding the price up to ensure they get every scrap of metal available before the bureaucracy clamps down. They are treating silver like oxygen. They are paying a premium today to guarantee they survive tomorrow. To grasp why this price difference is sustainable, we must dive into the industrial desperation where physics trumps finance. We need to pause here and really drill down into the mindset of the participants in Market B, because this is where the Western investor often gets lost. In the West, we view silver through the lens of a chart. We see resistance lines, moving averages, and Fibonacci retracements. If the price gets too high, the rational investor sells to take a profit. If the price spikes, demand is supposed to cool down. That is how a financial market works. But the industrial market in Shanghai operates on an entirely different set of rules, the rules of physics and survival. Consider the position of a factory manager in Jiangsu province who is responsible for producing millions of photovoltaic cells for the global solar market. This manager does not care about the relative strength index, RSI, on a daily chart. He cares about one thing, conductivity. Silver is the most conductive metal on the periodic table. It is not a choice, it is a chemical necessity. There is no substitute that offers the same efficiency. This creates what economists call inelastic demand. If the price of silver goes from $75 to $89 or even to $100, does the solar factory stop buying? No, because the cost of the silver in a single solar panel is still a small fraction of the total production cost. However, the cost of not having that silver is catastrophic. If they run out of silver paste, the entire billion-dollar assembly line grinds to a halt. Contracts are breached, market share is lost to competitors, the factory shuts down. So, when faced with the choice between paying an absurd premium of $89 to secure metal today or risking a factory shutdown tomorrow, the industrial buyer pays the $89 every single time without blinking. They are not speculating on price, they are procuring for survival. This is the reality that the paper traders in New York are ignoring. The algorithm trading silver in Manhattan treats it like a digital token. It buys and sells based on mathematical patterns. But the buyer in Shanghai is dealing with physical atoms that are required to build the energy infrastructure of the 21st century. Furthermore, this demand is being amplified by the just-in-time supply chain crisis. For decades, manufacturers kept very little inventory, relying on the market to deliver metal exactly when needed. That era is dead. With the export ban looming, these companies are realizing that just-in-time has become just run out. They are shifting from a strategy of efficiency to a strategy of resilience. They are building stockpiles, not for next week, but for next quarter and next year. This massive strategic hoarding creates a floor under the price that no amount of paper selling can break. The paper market can flash crash to $75 or even $60 based on sentiment and manipulation. But the physical market cannot follow it down because the physical metal is being consumed. It is being melted, pasted, and soldered into electronics that will stay in China. This is why the spread is widening. The West is playing a video game with numbers, while the East is engaged in a resource war for the raw materials of the future. And in the long run, physical reality always defeats financial illusion. The $89 price is the anchor because it is based on real consumption. The $75 price is the kite, blowing in the wind of Ghost Week volatility. And we all know that eventually the kite must come down to the anchor or the string will snap. In this case, the string is the arbitrage, and it has already snapped. This reveals the institutional strategy at play, which is simply front-running the new year. This brings us to the dark brilliance of the Western banks. If there is a risk-free $14 profit on the table, and they can't arbitrage it geographically, they have decided to arbitrage it temporally. They are arbitraging time. Why smash the price to $75 3 days before the biggest supply shock in history? Why sell when you know the price in China is $89? They aren't smashing the price because they want to sell. They are smashing the price because they want to buy. And they want to buy your silver. They know that on January the 2nd, the first trading day of the new year, the full desks return. The senior risk managers come back from Aspen. But more importantly, January 2nd is the day when massive institutional funds, pension funds, university endowments, sovereign wealth funds, rebalance their portfolios for 2026. Billions of dollars of fresh capital enter the market on that day. And where is that capital going to go? It is going to flow into the best performing asset class of 2025. It is going to flow into the asset with the undeniable structural deficit. It is going into silver. The banks know this wall of money is coming in 4 days. They know that when those massive buy orders hit the tape on Thursday morning, the price is going to rip higher. So they are front-running their own clients. They are using the low volume of Ghost Week to load up their own proprietary accounts at $75 so they can turn around and sell that same silver to the pension funds at $85 or $90 next week. They are buying in the past, Ghost Week, to sell in the future, January. This is why the $75 price tag is a mirage. It is a manufactured price point designed to create fear. They want you to look at the chart and think the trend is broken. They want you to feel stupid. Because if you feel stupid, you sell. And if you sell, they get your ticket to the rocket launch. Think about the entity on the other side of this trade. Do you really think that a sophisticated trader who sees silver trading at $89 in China is panic selling at $75 in New York because he thinks the price is going to 60? Of course not. The only people selling right now are the people who are being forced to sell, the stopped-out retail traders and the margin-called gamblers. The buyers are the sharks. The buyers are the ones who know that the China export ban isn't a theory anymore. It is a law that goes into effect in 72 hours. It is crucial to understand the blind spot of the machines and the mechanics of the inevitable squeeze. To fully appreciate the danger and the opportunity of this moment, we must look deeper into the mechanics of why the price is disconnecting so violently. We have to talk about the blindness of the algorithms that are currently driving the price in New York. You see, the high-frequency trading bots that dominate the COMEX do not read newspapers. They do not analyze geopolitical shifts. They do not care about export bans or industrial shortages. They consume data in a vacuum. They are programmed to react to one thing and one thing only: price action and liquidity flow. When a junior trader at a bank sells a block of futures contracts into a thin market, the algorithm does not ask why the sale is happening. It simply registers that selling pressure is increasing and that support levels are breaking. It then executes a momentum strategy, shorting the market to capture the trend. This creates a self-fulfilling prophecy where the algorithm drives the price down, which triggers more sell stops, which triggers more algorithms to short. It is a feedback loop of stupidity. These machines are selling paper silver at $75 because the chart tells them to, completely oblivious to the fact that the physical reality has fundamentally changed. This is exactly what happened during the nickel squeeze on the London Metal Exchange a few years ago. The algorithms were shorting nickel based on technicals, while a massive fundamental shortage was building in the background. When the physical buyers finally stepped in and demanded delivery, the algorithms were caught on the wrong side of history. The price didn't just rise, it doubled in a matter of days. The exchange had to halt trading because the banks were facing insolvency. We are seeing the exact same setup in silver right now. The algorithms are aggressively shorting a market that is physically tight. They are picking up pennies in front of a steamroller, and the steamroller is the January 2nd demand shock. When the physical buyers return and start lifting offers, the algorithms will be forced to reverse. They will have to cover their short positions into a rising market. This is what creates a melt-up. It is not just buyers buying, it is sellers panicking to buy back what they sold. Furthermore, there's a systemic risk here that few are talking about. It is the risk of force majeure. The spread between New York and Shanghai is now so wide that it threatens the credibility of the COMEX itself. If the price stays at $75 while Shanghai is at $89, every trader with a brain will stand for delivery in New York to take the physical metal. This will drain the registered inventories at record speed. If the COMEX runs out of metal, they cannot fulfill their contracts. They will be forced to cash settle, essentially admitting that the paper contract is worthless. The banks are terrified of this. They know that if the vault runs dry, the game is over. That is why this smash is so desperate. They are trying to shake out enough paper holders to reduce the open interest, the number of claims on the metal, before the new year begins. They need you to fold your hand so they don't have to deliver metal they don't have. This is not just a trade for them. It is an existential fight for the survival of the paper pricing mechanism. By holding your position, you are effectively calling their bluff. You are demanding real value in a system built on IOUs. And history shows that when a paper system collides with a physical shortage, the physical price always wins, and the correction is always violent and upward. Now, let's look at the forecast and the inevitable slingshot effect. So, what happens when the clock strikes 0? What happens on Thursday morning, January 2nd, when the world wakes up? We are going to witness what I call the slingshot effect. Think about what the banks did today. By smashing the price down to $75 on low volume, they have pulled the rubber band back as far as it can possibly go. They have created a deep discount right before a massive demand shock. On Thursday morning, two massive forces will collide simultaneously. First, the China export ban legally goes into effect, stopping the flow of metal. Second, the institutional desks in London and New York return to work. The senior traders will sit down, turn on their screens, and see two numbers: Shanghai at $80, New York at $75. They will panic. Not the panic of selling, but the panic of buying. They will realize that the inventory island of the West is about to be drained dry by the arbitrage vacuum. If Apple or Samsung needs silver, and it costs $89 in China, but only $75 in New York, where will they buy? They will drain the New York vaults instantly. To prevent the vaults from being emptied in a single afternoon, the price must rise. This is why I am forecasting a violent gap up. I do not believe we will slowly crawl back to $80. I believe we will teleport there. We could see silver open on Thursday morning at $82, then $85, then run straight for $90 to try and close the spread with China. The market will try to correct a 2-week mistake in 2 hours. But be warned, it will not be a straight line. When the volume returns, the volatility will be nauseating. We might see $10 swings in a single day. The banks will fight to keep control. They will try to smash it one last time. They will try to run the stops in both directions. This brings us to the conclusion and the final test of your conviction. My friends, this brings us to the most important advice I can give you for the next 72 hours. Do nothing. If you try to trade this, if you try to be cute and sell at $85 to buy back at $80, you will get slaughtered. You will get chopped up by the algorithms that are faster than you are. You are already holding the winning ticket. You bought the metal. You survived the Ghost Week trap. Now you just have to sit on your hands and watch the show. Do not sell into the hole today. And do not sell into the spike on Thursday, because even at $90, silver is just getting started. We are moving toward a world where the price is set by physical scarcity, not paper games. The era of cheap silver ends on New Year's Eve. The era of just-in-time delivery ends on New Year's Eve. The era of the real price begins on January 2nd. This $75 drop was the final test. It was the last chance for the banks to steal your wealth before the repricing. If you are reading this, and if you are holding your position, you have passed the test. The trap was set for the weak. The reward is waiting for the strong. The Ghost Week is ending. The real year is about to begin. And it begins with a bang. Stay calm, stay solvent, and I will see you on the other side of the new year.